There's a new kind of money on the rise. It's called a stablecoin. You might not have one in your wallet yet, but it's already changing how people save, spend, and send money across the world. And as of July 2025, it's officially on the U.S. government's radar. A brand new law just gave stablecoins rules, structure, and legitimacy. Which means this isn't just for crypto fans anymore, it's about to touch everyday finance. So today, I'm breaking down what a stablecoin is, how it works, what the new law says, and why it could reshape how money moves in the years ahead. Quick question before we dive in. Have you ever sent money online with PayPal, Venmo, Cash App, or a digital wallet? If so, you've already taken a step into this space without realizing it. Drop a comment, I'm curious how many of you are already halfway there. And if you find this kind of breakdown useful, hit subscribe so you don't miss the next one. What exactly is a stablecoin? At the simplest level, it's digital money designed to keep a steady value. Unlike Bitcoin or Ethereum, which swing up and down in price, a stablecoin usually equals $1 and it stays that way. That stability is the whole point. Crypto like Bitcoin might be fun if you're investing, but it's too unpredictable for things like rent, groceries, or sending money home. Stablecoins fix that by being the first type of crypto that actually feels usable day to day. And here's the kicker. Stablecoins live on the blockchain. That means they move instantly across apps, across borders, 24/7 without waiting for a bank to approve the transfer or charging you high fees. Imagine sending $100 to a cousin overseas. Instead of paying $20 in wire fees and waiting days, you send a stablecoin. It arrives in seconds. Your cousin can cash it out locally or hold it if their local currency is unstable. In fact, in countries battling hyperinflation like Venezuela or Argentina, stablecoins are already being used as lifelines, giving people access to U.S. dollar value when their own money keeps losing ground. How do they stay stable? Most stablecoins are backed by real assets. For every $1 stablecoin in circulation, there's $1 in a bank account or U.S. treasuries sitting behind it. Think of it like a digital receipt. Trade in the coin, get your dollar back. That's the model for coins like USD Tether or USDC Circle. Others are crypto-backed, using assets like Ethereum as collateral. But they over-collateralize, locking up $150 worth of crypto to issue $100 worth of stablecoins, just in case prices swing. And then there are algorithmic stablecoins, coins that use code to manage supply and demand instead of real assets. Sounds clever, but in practice it's been shaky. Remember Terraust in 2022? That collapse wiped out billions and soured most of the industry on purely algorithmic models. The big shift. U.S. regulation. Here's where things just changed. In July 2025, President Trump signed the Genius Act, the first U.S. law written specifically for stablecoins. Genius, short for Guaranteed Essential Neutral Issuance and Utility Standard, sets strict rules. Coins must be fully backed one-to-one with safe assets like cash or treasuries. User funds can't be mixed with company funds. If the company fails, your reserves are still safe. Monthly audits are required. Anti-money laundering checks are mandatory. And stablecoins aren't classified as stocks or bank accounts, which clears up years of regulatory gray area. The result? Big finance immediately jumped in. Major banks, payment platforms, and financial institutions announced new stablecoin projects and digital dollar pilots. What used to be a niche crypto experiment is now attracting Wall Street. The opportunities and risks. Does this make stablecoins totally safe? Not quite. Experts still worry about what happens if private companies issue too many digital dollars. Could it weaken banks? Could it affect how the Fed manages the economy? There's even debate about whether stablecoin issuers should get access to FedWire, the U.S. central bank's payment system. Globally, the stakes are high too. In countries with weak currencies, stablecoins can replace local money, great for citizens in the short term, but it risks undermining governments in the long run. And then there's geopolitics. China is already pushing its digital yuan. Many believe the U.S. fast-tracked stablecoin rules to keep pace, because whichever country leads in digital money could gain real economic leverage. What this means for you if you've ever been frustrated by bank fees, transfer delays, or international wires, stablecoins could matter. They're basically programmable dollars, instant, secure, and usable in apps being built right now. Whether you're a freelancer getting paid from abroad, a business owner moving money, or just someone sending cash to family, this could save you both time and money. But in this is key, make sure you're using legitimate coins. Look for transparency, audits, and compliance with U.S. law. Stablecoins aren't science fiction anymore. They're real, they're growing, and with laws now in place, they're becoming a serious part of how money works. So, what do you think? Could stablecoins replace regular money someday? Or do you worry about trusting private companies with digital dollars? Let me know in the comments. And if you found this breakdown useful, hit subscribe. I've got plenty more insights coming on the financial changes shaping our world. Thanks for spending some time here, and I'll see you in the next one.